Hello and welcome to the Expert Investor Show, where we look at some of the key stories of the past month and how these might impact your personal investment journey. As this is our first show, it is worth providing a quick overview of what you can expect from these episodes. The show will have 3 segments. The news, where we look at the key headlines from the past month, what impact this has had on markets and whether it's changed the outlook. Reviews, where we run the rule over a different investment each month and assess what it could do for your portfolio. And interviews, where we chat with a target audience member to discuss their personal investment journey to find out how different people save and their views on the investment industry. Now, with that background in place, it is time to discuss what's coming up this month. In the news, we look at the resumption of the war in Iran and what that has done to markets, as well as the ups and downs of the AI bubble. Our review this month is Fundsmith Equity, about as close as we have to a household name in the industry. Whilst our interview is with House of the Dragon stuntman Sam Stefan and what lessons being set on fire for a living taught him about investing. Now that is a very interesting conversation, so do stick around to the end for that one. But as promised, we will start with the news and the biggest factors driving markets in July. As expected, the biggest impactor on markets was the resumption of the war in Iran. Now, this has been going on since the end of February, so that ground is pretty well known at this point, and frankly, geopolitics is well beyond the scope of the show. So let's instead focus on what impacts this has had on markets. Well, the key swing factor has been the oil price, which has again surged following the latest escalation. Now, the problem that the oil price has is that it impacts day-to-day prices, as this helps keep the economy moving, literally, and has a lot of consequences. These rising prices, as you probably know, are called inflation, and high inflation is generally viewed negatively. Now, the major tool economies have to control inflation is interest rates, which are controlled by central banks, a usually independent organisation that helps stabilise the economy. As interest rates go up, it restricts the amount of money households and businesses have, therefore slowing spending and cutting inflation, in theory. Now, this is of course bad for company earnings and therefore for their stock market valuations, which are typically based on what profits a company can make. So that's the theory. So what's happened in practice? Well, not much in truth. Most major markets are kind of flat in July. The FTSE is up a little bit because of the oil majors, and the one exception really is Asia, which includes China and India, but crucially not Japan, which is classified separately. Now, the Asian markets fall around 6% due to the higher exposure to oil, as many economies import lots of it. But since the beginning of the year, the region is up over 20%, despite the big sell-off when we first started the war and the latest move, something we'll touch on later. Now, as such, investors are clearly looking through the impact of the Iran war and seeing it as temporary, not structural. They've given the prospect of interest rates rises as a low probability, although betting on Trump's next move is always a risky one. Now, the next biggest story that's impacting markets is AI. Now, this has been a major factor since 2022, really, when ChatGPT took hold in the public consciousness. Since then, most things AI related have rocketed, particularly in Asia, which is home to several of the key companies in the supply chain, something we recently discussed in an article. However, in recent months, there has been some back and forth over how much spending is going to be required versus what AI revenue might be generated. In July, the parent company of Google, Alphabet, announced over $200 billion of spending, which led to some selling off in markets, which were concerned that the outlay may struggle to generate enough revenue, as well as other AI rivals will have to spend that amount in order to keep up. The AI trade is clearly getting some pushback, and the spend required is looking huge, but with so many firms looking to adopt it somewhere, there's a real push and pull from investors wanting to capture the growth potential, but being concerned over who the winners will be. Ultimately, I think most people here will admit they're going to be using more technology in 5 years' time, not less. So the sector clearly has growth potential, although where that lies is very difficult to assess. Fortunately, on the Expert Investor site, we have a couple of options for investors looking to navigate these challenges, including a low-cost passive ETF, as well as an active manager looking to stay on top of the trends. And with that, we end the news and move on to our next section, reviews, where we pick a different investment each month and discuss its merits and how it could work for your portfolio. As it is our first month, we will start with one of the industry's largest and most well-known vehicles, Fundsmith Equity. Now, this fund launched back in 2010 and is managed by the eponymous Terry Smith. He has a global approach, allowing him to pick companies from any market globally, although he mostly focuses on more established regions such as the US, Europe, and then some in the UK too. He has a very straightforward motto when it comes to finding companies. Buys good companies, doesn't overpay, does nothing. Now, in theory, this sounds great, although such an approach has caused some challenges more recently, as we will discuss later. He doesn't hold that many companies either, usually just around 20 to 30 in the portfolio, meaning each pick needs to be really good, as it can have a big impact on performance. These companies are usually those with advantages rivals will struggle to replicate, such as Visa, plus those that have stable financials, making sensible profits without using too much debt, and can grow regardless of what the economy is doing. Now, as alluded to, it is time to discuss performance. Fundsmith had an exceptional run through much of the 2010s, regularly being a top-performing fund and as such attracting considerable assets. Therefore, its size is around £12 billion now in assets under management. However, from around 2022, performance began to falter as companies in specific areas became more popular when inflation started to become a problem. The winners here were called value companies, those on cheap valuations and that can benefit from the likes of inflation, such as oil stocks. Now, whilst Terry does have his don't overpay motto, his stocks were not really value stocks. Instead, they were growth stocks, and therefore they became out of favour and started to have a bit of a pullback. Furthermore, he was then caught out by AI stocks doing well, which again didn't really fit in with his very disciplined strategy. Despite this, the longer-term performance remains strong, and it's difficult to argue that his type of company won't ever be popular again. So, the big question, does it deserve a place in your portfolio? Well, Fundsmith Equity offers exposure to some of the best global companies, selected by a manager with generational experience. The portfolio is concentrated, meaning if these picks prove correct, they can have a big impact on performance, and the fund has a really good chance of beating the wider market. However, should this style remain out of favour and instead investors prefer a narrow band of stocks, whether that be more economically sensitive stocks like banks or oil or high value tech companies, then the fund may well continue to struggle and may not beat the market. Okay, it's now time for our final section of the show, the interview, which we have nicknamed Amateur Hour, although we should preface this by saying that our guests are very talented individuals in their own fields, and there's no way we're going to keep them holed up for an hour. Now, our guest this month is Sam Stefan, a stuntman from London. He has appeared in films such as Batman and Mission Impossible, and is currently starring in House of the Dragon. When he came in a couple of weeks ago, we discussed a range of topics, from his own investment journey and what lessons he has learned from the experience. So our first guest on the show will be Sam Stefan, who, you can tell us what you do, Sam, but please tell us what you do for a living and confirm that it's not finance.
It's certainly not finance. I've been working in the stunt industry in the UK now for 13 years. All in all, probably around 17 years. I was sort of in and around the industry, but professionally, 13 years now. Yeah, in my 13th year, which is shot by.
Yeah, that's a pretty unusual job, not something that we would come across, and probably not a lot of transferable skills to our industry. So can you just tell us a little bit about sort of things that you've been in recently for a bit of context that people might know?
Yeah, so over here, simplifying that, we have good tax breaks. So we do a lot of American films and stuff like that. There's a lot of American money over here. So a lot of Marvels, superhero. Obviously, we have the Bonds in this country. I've done Game of Thrones, House of Dragons. And that's to name but a few. Yeah, we're lucky. It's busy. It's booming over here at the moment. So long may that continue. Yeah,
and in terms of just taking it back to finance a little bit, when you've got those sort of roles, how long would one of those last for? How much planning are you able to put into that?
Oh, so if you're doing your normal average film, they'll shoot for around 6 months. You might have a couple of months prep, so you're looking maybe 8 months. If you're doing like a VOD, video on demand now, like a long TV series on HBO, a Game of Thrones, that can be from January pretty much through the year till November, something like that. So you start looking 10, 11 months of the year. So yeah, this a lot of planning and prep sort of goes into those big films and TV shows.
And then, so we're going to have to take it back to finance, I'm afraid. Like,
Let's do it.
Let's do it. So what really are your savings goals? Give a bit of like context and background as to what you're looking to get.
So my I have a pension, which gets paid through equity, it's our union. I have that, and then I try and put away. How much do I try and put away? I do. You
can do it as percentages.
I do put away a percentage, which goes into different investments. I guess I've got probably quite a wide portfolio. I put money into property. I have investments in lots of different things. It's honestly quite a wide portfolio, from crypto through to the FTSE. I've got money in the FTSE. I've got money in different companies. Yeah. So I try and spread my bets as best I can. It depends where I'm at. As you know, I did a house build last year, so my savings and stuff like that I'd normally be putting into investments have gone into the house. But again, it's gone in somewhere healthy, I would say.
So you're mostly sort of finding a balance of like long term, which is like your pension, saving for the future, and then some short term stuff as well. Was the short term all just straight in, straight out?
No, yeah. I mean, I guess it's more long term investments. But it depends what finances I have available. Yeah. So next year, now, like I've said, I've just finished a house build. So now I'm starting to save up again and stuff like that. And I will look to, again, invest more money into different bits and pieces once I have some.
Yeah. And in terms of like when you get some, when you've got a big long shoot on and you've got a bit of sort of spare cash to throw around, where do you go looking for investments? Is it like through the brokers itself? Is it through the financial news? Is it through bad advice from friends?
Yeah, normally bad advice from friends. If you want bad trading advice, you go onto a film set, because you've got people in the creative industry that quite happily tell you their 10 pence on where to put your money and all that. So I try and do research as best as one can. Yeah. But it can be through friends and stuff like that. And like I said, I will try and look up companies that I think maybe potentially have a future, or something that I believe in. Yeah. Maybe whether it's a product or whatever that company's producing. Yeah. And and I'll look to invest little bits and pieces, but really, it's quite spread. Yeah. Quite diverse.
So you'd prefer to invest in a company directly itself rather than maybe finding a professional manager that does it? Or do you like investing in like just broad markets?
I like to market. So I will invest in like sort of broad markets, again, and companies. But I think next year I wouldn't mind having a broker, someone to maybe, who's got more knowledge than myself, to spread, put my money in somewhere that's going to gradually grow over time, and use it as a bit of a pension pot. That sort of thing. So
and so thinking back to your knowledge level, on a scale of 1 to 10, where would you put your financial knowledge? If 10 is that sort of person that you want to give money to, 1 is that guy from your film set who's telling you to shove it all in crypto. Crypto might be a good investment, we don't know, but like, where would you put yourself on that scale?
I would put myself. I'd have to put myself at like a 4. I've had investments that have gone quite steady, that have had short-term results, and I've had investments from people I've listened to that have tanked. So a 4, a 4. I'm probably, it's probably the wrong, like I said earlier, to listen to people that maybe set themselves on fire and fall out of windows, taking financial advice off, is probably not the best, because they're, really adrenaline junkies. They can make on the spot decisions and stuff like that, which is great in the job that they do. but not necessarily for finance.
Yeah, well,
advice.
we have a risk reward balance, and it seems that you guys just have risk.
It just 100% risk. Yeah, yeah.
So, what do you think would help you move up the scale from 4 to 5 to 6? Like, what sort of resources would you think you would need to get there?
Someone within the industry now, I think. So like I said, next year, once I start work again, I think I will look for professional advice. Mm-hmm. I've done, like I said, bits and pieces for myself and through friends, but I think for my investments to really start growing now, later in life, I would probably look for a professional to invest my money for me, keep me up to date, explain in layman's terms how things work. Because it's not really my world at all. Yeah. I do, like I said, bits and pieces of my own research. Yeah. But I still don't have the knowledge. I haven't trained in this industry. So to have someone explain in sort of layman's terms how things work, I think that would help me, take me to the next level. Yeah. I mean, you mentioned training there, so we'll touch on that point. Like, did you have any financial education growing up? Was there anything from either friends or family or from school? Or do you think it was a bit lacking? Lacking, really lacking. My parents, they weren't. Do you know what? My grandparents, I think they invested money fairly well. My parents, not so much. They weren't really taught, so I didn't really have much information passed down to me. Schooling, I don't even know if investments I mentioned, I can't remember. I don't think it was, because maybe I would have taken some of that information that was given to me. Yeah. So very little when I was younger. Yeah. And do you think that has sort of led to problems later in life? Yeah, I would say so. Yeah. I would say so. Yeah. Knowledge. If you have someone or someone that can give you that knowledge from a young age, it really sets you up. Yeah. For later in life, and we all do want to retire at some point. Yeah. And obviously we're going to need money to do that. Yeah. So where would you turn if it weren't for a financial advisor or spending money on getting advice? Who would you turn to now for that? Would it be family now? If your grandparents still around? Probably friends, but friends in business. Yeah. So if I wanted financial advice, I would look for friends, who work in the city and whatnot, who work with money. Yeah. Usually the worst people to ask in our experience, but I mean, that might be true. But people that have been successful, people that I've seen be successful with their money and have set themselves up. Yeah. They're the people that really I want to be asking advice from. Yeah. Not Joe Bloggs, who's told me to chuck X amount into some mad crypto scheme, meme coin. Yeah. Not that anymore. Anymore, you've done it before. Yeah. I've done little bits. Yeah. And what about social media as a sort of avenue to find that sort of advice? Have you found anything useful? Do you find it a bit of a cesspit? No, because my research into finance, it can come from social media. Social media is massive now, so I get fed all sorts of information. I like, if I do see a meme or something like that, something financial, I will tend to look up and try and find the source. Yeah. But no, I think it's very valuable now. People like myself that don't know a lot, if you can find a creator or someone that's producing valuable information, it's brilliant. It helps the masses really, because I don't think many people know about their finances, and certainly don't prep for the future in the way they should. Yeah. Yeah. So if you were, taking that point, if you were to be able to speak to your younger self, what would you say then about saving? Set yourself on fire more, a bit more. What would I do? It's hard to know now whether the decisions that I've made were the right ones. So, in my head when I was younger, buy a flat, buy something, right? So I bought my flat 8 years ago now, 9 years ago, thinking that's what you do, and that will go up in value. That's stayed the same.
Yeah.
So in hindsight, you look back and go, okay, well that money might have been better to be with a broker or someone who's been investing that over the last 9 years, you know, and have a gradual, I don't know, 5 to 10% increase or whatever.
Yeah.
Because the flat, you know, hasn't done anything.
Yeah.
It's just sat there. So,
but it's provided a roof over your head.
It's provided a roof. It's provided a roof over our heads, and you know, it's not a bad asset to have.
Yeah.
Potentially, eventually, you know, maybe in 20 years' time, once it's gone up 500 quid or whatever, where we're going at the moment. But yeah, it's hard to know. I think what I tell my younger self now, because I think I did the right things.
Yeah,
I tried to save. I didn't go and buy silly things. But time will tell. Time will tell.
And you said that sort of when you would look to be in the markets, you look sort of 5 to 10%. Is that what you think like the market goes up by? Is that what you think a good return is, or would you expect more?
To be honest, I'm not even 100% sure. You know, I look at certain investments and I hear, like, you know, 10% is a good return. Obviously, you know, higher would be brilliant, but you know, I would say off the top of my head, 10% is pretty solid. Not great, but not the worst. Probably like mid-range sort of return on investment, something like that.
So, like, obviously 10% for many of us, we could consider it a pretty good return, especially year after year. Double your money fairly quickly there. But perhaps, like, ending on sort of quite an amusing note, can we look back at some of maybe your worst investments, perhaps some of those tips that you got from other people on set, and tell us a funny story about one of those?
I mean, there's a few, but the one that I still actually have money in is Neo, the Chinese. Supposedly was the Chinese Tesla at the time, pre-COVID. It was like, right, come on, let's put some money in this. And to be fair, I actually, again, you know, I did do my research. I liked what they were producing. But oh dear me, that has well and truly underperformed. I think I might have bought in at $30 a share, something like that, and now I think it's like $4. So that has got a bit of climbing to do before we level out again. But I think that was about 7 years ago. I think it was just pre-COVID.
And who gave you that tip?
That was actually a friend. That was a friend at work who said, this is going to be big. And do you know what? I lapped it up. I went, yes, this is going to be huge. And then it absolutely tanked. But who knows? Who knows what the future holds? Maybe it'll be a $500 a share by 2030. Said no one ever.
Brilliant. Well, we're going to park it at that. No pun intended. Sam, thank you very much for your time today. I really appreciate it.
Cheers.
Well, some really interesting insights from that chat with Sam. Now, if you'd like to see Sam in action, he actually features heavily in episode 8 of the current House of the Dragon series, doubling up for John Roxton. So make sure to keep an eye on him there. And on that note, it is time to wrap up the Expert Investor Show. Thank you so much for watching. It's genuinely been a pleasure to do this. And if there's anything you'd like us to cover in future episodes, please do get in touch. These videos are produced to help you with your own investment journey. Therefore, the more feedback we get, the more insightful we can make them. Once again, I'm Ryan Lightfoot-Amanoff, and this has been the Expert Investor Show. We look forward to speaking to you next time.